In this episode of the Slow County Real Estate Podcast with Hal Sweasey, Ben Lerner from Cross Country Mortgage stops by to tell us about an exciting program for first-time homebuyers in California.
I'm renting right now. My rent is going up. I've got 2 dogs, a kid. I need to get a place, and I'm paying $3,000 a month in rent. I got to get into a house. How do I do it? I don't have any money.
Yep.
What do I do? And that's what this program is for.
Somebody I heard talking about this yesterday, and they predicted 90 days. That's how long the money lasts. So if you're someone who's thinking about buying a house and using this program, I would think you'd want to do it sooner rather than later.
While the Dream for All Shared Appreciation Program might not last long, Ben also gives us tips on other ways a first-time homebuyer shouldn't be as rare as it is by offering lender incentives for 3-2-1 buy-downs in the state. Making living the dream a reality on this episode of the Slow County Real Estate Podcast with Hal Sweasey. Here's your host, James Bueno.
Slow County Real Estate with Mr. Hal Sweasey. Man, we're back. Hal, how you doing, sir?
Good.
Good. And JT, how are you doing?
This is awesome, man. This is the best day of the year.
We'll go back to that here in just 1 second. And then who else we have? Mr. Pete, how are you, sir?
I'm excellent, thanks.
And then Hal, back by popular demand, we have a guest.
Yes, Mr. Ben Lerner, who's been in the mortgage finance business at least 2 decades. Is that right, Ben?
That's correct.
And Ben gets the round of applause that we give to everybody like normal.
Yes. He hasn't put his money in the $100.
It's the envelopes.
Yeah,
he's got to do the envelopes, the 100 envelopes.
Welcoming Ben Lerner here, mortgage broker for years here, representing Cross Country Mortgage, and there's so much happening and changing between interest rates and what people are doing to buy homes, finance homes, et cetera. So I thought it would really be good because there's a lot of really cool information going on. Let's just start with rate buy downs because that's a lot of things that we are used to, but we haven't seen for a while, and it'd be good for our listeners to hear about.
A rate buy down is an excellent way to kind of help overcome the higher interest rates that we're dealing with right now and help with an easier payment to get the borrower into a home, be able to afford the payments, and maybe give them a runway to where we can refinance them to a lower long-term rate.
Okay, good.
Yeah.
So somebody's buying a house for, let's say, $500,000. Let's say they're going to put the typical 20% down, so that's $100, right? So they get a loan for $400. So what does that look like? What would be an example of that with like actual interest rates and the options a buyer might have?
Yeah, so if you did a buy down, so let's say a seller or the agent or me as the lender provides a buy down to that borrower, let's say we do a 1-year buy down, a temporary 1% buy down for the first year. If they're at 6.5% on their note rate on that mortgage, on that $400,000 mortgage, for the first year, for the first 12 payments, they would actually have a payment that's equivalent as if they were at 5.5% instead of 6.5%. And there's no penalty if they refinance earlier. Whatever is left in that account for those full 12 payments goes to the borrower. So that's always their money.
Okay. So way back, say in the 90s, I remember there was this 3-2-1 buy down. So if I'm not mistaken, that's like, okay, the rates are, back then they were probably 7%. So then you were at, 6, 5?
You're at 4%.
4% for the first year. Then what happens?
Then you step up to 5%, 6%.
Second year, third year, 6%.
Correct.
You had a long time before you got to that 7%.
Exactly.
Okay. And that was in the days like first-time buyers thinking, okay, I'm new in my job or I'm just getting myself started. I'm assuming I will make more. And John always likes to talk about this when he talks about affordability, but he talks about what people earn. And I'm going to let you kind of step in, John, because you always love to talk about this, right? Because he must make money.
I call it stretching. And what I mean by that is, if you're looking at a $500,000 house and you can stretch and buy a $600,000 house, I think 20 years from now, you'd be glad you did. That doesn't mean you're on, eating beans and tortillas forever or peanut butter and jelly sandwiches. It just means that you're just challenging yourself to get into that little bit bigger payment than maybe you thought, because down the road, you're going to grow into it and you'll grow beyond it with your income. I was looking at median household incomes for the last 50 years today. 50 years ago, the median household income in this country was under $10,000. And today it's over 70. It's gone up 7-fold. And just in a 5-year period, let's say you bought a house in 1972 with a $10,000 income. 5 years later, your income's up 35%. Do you think you grew into your house payment? And it's true today too. Yeah. It's true from 2017 to 22. Incomes are up about 17%.
Yeah.
So could you grow into your house payment?
I used to love the concept of the 3-2-1 because it's kind of like if you have a child, you're prepared for a baby, but it takes a while to get ready for a 1-year-old. I think financially you'll learn to own a house. You get in a lot easier, and then over time you either grow into it, you handle it, you put money away, or you make a little bit more, and you can handle it. So I just think it's a great thing to do. Ben, what happens, like you were talking about, because if the rates were to fall, and how does that, like they put a pool of money aside when we say buy down, right? So explain that and what would happen if, like, after a year, oh my gosh, my 6%, I can now refinance at 4.5% for 30 years.
Yeah, I mean, basically, when we do the buy down, the entire amount of that buy down, the full amount that is the difference between, in your example of 7% down to 4% on a 3-2-1, that full difference between the payments of a 7% note and a 4% note, it all goes into a giant escrow account.
Right.
If in 6 months the rates have dropped tremendously, which could happen, then we would refinance them, and whatever is left in that pool, let's say it's $30,000, it would go to the borrower's principal balance. It would pay down their loan with that money, so they get it.
And I'm going to put you on the spot a little bit. So so let's say $400,000 loan, today's rates, 3-2-1 buy down. Get that calculator out. I'm going to give you a second. If we wanted to do a 3-2-1 buy down, and rates today are around what?
6.5.
6.5. So then you're starting at 3.5, 4.5, 5.5, 6, right? 3.5.
That's correct.
So about how much would that contribution of that buy down amount have to be, roughly?
It's equal to about it's about 0.8 of a point for every 1 year buy down, and that would be 6 years buy down.
Okay.
So it's basically 8 times 6, so it's about 4.8 points to buy it down.
Okay. You said 6 years? Not. Why'd you say 6 years?
Well, so 3-2-1 buy down is actually the first year. The 1 is 1 year.
Oh, gotcha. And then 2. Yep.
Yep.
Okay.
So it's actually 6 points to get there.
Okay. So that's $24,000.
Correct.
Okay. So in January of 2022, just over a year ago, nobody was going to get any buy down paid for by the seller. They're going to have to pay an extra $100 or $200 for the house.
Yeah, and actually, just a quick correction: it would be 4.8 points of a $400,000. It would be 4.8 times 4, so it's closer to about $20,000.
Okay, so $20,000, but a seller may be more apt to give someone a $20,000 credit now that markets leveled off. So there might be some give by a seller.
Correct.
And for that, they could have a huge change in their payments for quite an amount of time.
Correct. And it's really a win-win because they're getting the funds. Sometimes the sellers have reasons for not dropping, especially if it's a builder or other reason. They've got reasons for not dropping that sales price.
Yep.
And so it can be a win-win.
Yeah. Okay. And yeah, in a $500,000 house, $20,000 off the price is not that big a deal.
Yeah, and it is common. I think this is a more common. You can't do buy downs on a lot of the jumbo products. So this really is a conforming loan product, which means it's for loan amounts less than 911 on a single-family home in our county,
right,
unless it's VA. And that really, you're dealing a lot with more entry-level first-time home buyers. And like you said, this is a great way for somebody that is okay maybe for the first 6 months having top ramen and oatmeal every day. This is a great way of stepping into a house, having an easier payment, and letting them step up and grow into the higher payment.
Yeah.
Yeah.
Okay.
Yeah,
well, it'd probably be equivalent to a rent increase, right? Will the payment be like 10%?
Yeah,
higher, you think?
On your scenario with a $400,000,
roughly?
it's going to be about $250 for every percent.
Okay.
Per month difference.
Right.
So you're talking about a $750-ish savings on the 3-2-1 for the first year.
Right.
And then $250 less the next year and $250 less the next year. So it's a good step up for sure.
I mean, if you're renting a place for $2,000 a month, the next year it could be $250 higher, right?
Yeah, and after your first year, you get your tax deduction. You get to see how much the house is helping you.
Okay.
Yeah.
If I'm that buyer at $500,000 and that the only way I can really do this is with a buy down. Let's say I'm talking about 3-2-1, and it's $20,000, but the seller won't give me a credit. Could I potentially offer him $520 for the house with a $20,000 credit? How would that all work?
Sure. You could do a $520 and a $20,000 credit towards seller. There are maximums on the amount that you can give depending upon the down payment that the borrower is doing, but that scenario would work in almost every case.
Okay, that's cool. And so, Ben, you guys as a company at Cross Country Mortgage, I think, are helping buyers with that yourselves. What do you guys do in that case where you actually provide assistance?
It was really born out of trying to help the realtors get any of their buyers off the fence that may be sitting off thinking that the rates are too high. And so we came up with just covering that 1 year buy down on our office. So on any conforming or government loan, we pay for that first year of the buy down at no cost to the borrower.
Great.
And then we try to help. We firmly believe, as does every legitimate economist I've seen, that rates are trending downward. Mm-hmm. And so we believe also that we'll refinance that person, and we do that for free as well.
Gotcha. Good. So they get all the benefit of a potentially lower rate and no cost to do that.
That's
Zero
correct.
cost?
Zero cost. We cover all the fees.
Wow.
Fully covered, man. Sounds great.
I
Love
know.
it, Ben.
Yeah. So there's that new program. It's so for a first-time buyer, which includes someone maybe that hasn't owned a house for 3 years. So not first time.
That's correct. First-time home buyers, no ownership in 3 years, and not on title either. So it comes up sometimes where somebody's inherited Aunt Sally's house in Florida, and that counts as ownership if they're on title.
Or a lot in California Valley.
Correct.
Oh, okay. So anyway, how does that down payment assistance? Because I heard something about it, and I would love to hear it from you. What's actually going on?
Yeah, there's we have what are called bond loans. Every state has them. In California, we have an agency called Cal HFA, and last year we had a tremendously successful bond loan called the Equity Builder, and it made a lot of waves. And it ran out of money in November. It was essentially a 10% loan that was forgivable over 5 years. And so it was a great way for somebody to get 10% from the state. They go into this loan. They could do zero money down. They could use a percentage of that 10% to cover all their closing costs, all their fees, and they could step into a house with no money down, with some equity in the house, and with a great rate on the loan. And there's a little bit, any type of government loan always has a little pound of flesh that they take. There is an origination charge on these loans, but again, that can be taken out of the fees as well.
Right.
So that program ran out of funds in November, and it left a lot of people wanting that program more, obviously, with the rates and with the difficulty with pricing right now. And so this new program just rolled out. It's literally, I'm just getting acquainted with it. I've yet to do one. It's a day old, and that's the Dream for All Shared Appreciation Program from Cal HFA. And it's actually, instead of a forgivable second, what they're doing is they're actually giving up to 20% of the down payment on a loan if you qualify within their income, which for us is up to $216,000 household income. It's a pretty high bar, correct?
Oh, okay. So there's not real restrictive. That's pretty...
There's different tiers of how the loan is repaid based on your income, but it's the Cal HFA limit is $216,000.
So if you got two people making $70,000 a year, that's $140,000.
Correct.
So let me be clear. This is if I'm looking at a house for, we'll call it $600,000 because that's a little bit more realistic in the county.
Yeah.
So they'll give you $120,000. Well, I say give, but you'll get $120,000.
Yeah, I believe the program, and I'm just digesting. I believe the program has a $100,000 limit.
Okay, gotcha. So there goes James' $3 million house. Who's going to borrow $600,000 for that 20%? Okay, so $100,000. That's good. So on a $500,000 property of some sort, you can get up to $100,000 for your down payment, and that can be it, and get a loan for $400,000.
Correct.
And then how does the state make money, or what do they do with the $100,000 that they just got?
Yeah, so they charge an origination on it. So it's a bond loan. So it's self-perpetuating. So the fees that are in the loan do contribute to keep the bond going. And although they do run out of funds, like we saw last year with this Equity Builder loan. But essentially, instead of last year's program where it was forgivable over time, this one is a shared appreciation program. So let's do an easy scenario. Let's say it's a $100,000 purchase, and somebody gets the 20% or $20,000. This program allows, assuming it's a normal income person, which above 80% of the adjusted median income, which is above $87,000 in our county. If you're above that income level, then it's a 1-to-1 share up to 2.5 times, and let me explain that. So if somebody gives if the Cal HFA program gives $20,000, and you buy a $100,000 house with it, after 5 years you sell the house for $200,000, Cal HFA would then get $40,000. They would get their equity at an equal measure of the growth of the home. And that maxes out at 2.5 times. So in that scenario, that $20,000 can never be worth more than $50,000 to Cal HFA. The borrower would keep it. But they are sharing in your appreciation of the home over time. So they're getting the same piece of appreciation on their down payment assistance that you get on the 80% that you own.
But there's no cost along the way. There's just the upfront cost.
Yeah, it's a closing cost. So generally speaking, there's a minimum charge of 1.5 points in origination for Cal HFA.
Sure.
Most of the time they're at 2.5 points.
Okay.
Because there's also no compensation to the bank for these.
Right.
But that can also come out of that down payment. So, for example, somebody borrows 20% or $100,000, they could use those fees to also cover all the closing costs, and the difference can go to the down. So maybe they're doing 17% down payment or 16%. They're still going to have a great loan.
I just want to make sure. So you get somebody $500,000 house. I'm going to get the full amount, $100,000. They're going to charge 2.5% or 2.5 points based on the down payment assistance, the 100.
Based on the purchase price of the home, based on the loan amount.
But the loan amount.
The loan
okay,
amount.
so 400.
Correct.
Is the loan.
Correct.
So that goes to Cal Haffa for the down payment. Okay.
That's
so
correct.
that's $10,000, right? 2.5%.
Correct.
400.
So a part of the money they're giving you goes back to them, basically.
That's how you pay for the free money.
Correct.
And it's not free, but yeah, okay.
Correct.
Versus payments.
Yeah.
So there you go. You got a 20% down. You really can come out of pocket with almost nothing.
We did the Equity Builder last year, several of them that way, where you walk in, we use a portion of the down payment assistance, cover all the closing costs, the rest goes to the down payment. They step in without a penny out of pocket.
Okay, so I just want to be really clear, and I'm sorry to hog this, but $500,000 house, I'm going to have to pay 2.5 points on the $400,000, so I'm losing $10,000, right?
Correct.
So I need $10,000, and maybe I get the seller out from $500 and ask for a $10,000 closing cost credit, right?
Yeah.
So now I've got my down payment for nothing.
Correct.
I'll have some other costs, right? A few $1,000s in other costs.
Yep.
So with a few $1,000s, then I get my down payment. I'm paying on a $400,000 loan, and if I sell the house for $700,000 in 8 years, okay, that's what, a $200,000 gain, and you give them back their $100,000. You get your $100,000.
You give them back theirs.
Give them their equity.
Yeah, their percentage grows at the same percentage of your house,
Right.
of your part,
Right.
up to 2.5% of up to 2.5 times their initial give.
Okay, so I bought for $500. I sold for $700. How much does Cal Haffa get paid back?
Well, I'll keep it easier. Let's say you buy for $500 and you sell it for $1 million.
Yes.
You would double your money and they would double theirs.
Okay. So you pay them back $200.
Correct.
Okay. On a few $1,000 investment.
That's correct.
And making the payments.
Correct.
But you get a place to live, right?
Yeah, it's a great
Normally.
way. It's a very common call. Is I'm renting right now. My rent is going up. I've got 2 dogs, a kid, and I need to get a place, and I'm paying $3,000 a month in rent. I got to get into a house. How do I do it? I don't have any money.
Yep.
What do I do?
Yep.
And that's what this program is for.
I had a question, but in order to qualify, can you come in with any of your own money? Like you say, you have some of your own money and you just need to bridge the gap in order to get into the house that you want to. You can access this program that way as well?
Yeah, there are lots of different Cal HFA programs. This one is just like the Equity Builder last year. These stand out when they run this sort of a program. It kind of makes the others seem poor in comparison.
Yeah.
But the honest answer is yes, you don't have to take the full amount. You can take a set amount. But the origination charge for the money is the same. So I'm not sure it may not make sense, and I would pencil it out with you. You're probably better off taking the full deal.
I see.
And just lowering your expenses during that time. There is you can't have more than 30% equity in the home, a 70% loan to value on this program. So if you had, that's to say a different way of saying that, if you had your own funds you wanted to bring in and you were going to borrow the full amount on this $500,000 scenario, so let's say you borrowed 20% from Cal HFA and you already had 20%, you wouldn't be able to put your full 20% in. You'd have to keep your some of your funds out because you couldn't put more than 30% down.
So we've been talking about kind of a 20% down scenario. So I find a $600,000 house. The program allows for $100,000, which is about 16-17% down. So the program could still work with those numbers. I just have to pay PMI.
Yeah, correct. You'd have mortgage insurance, which is, if your mortgage insurance more than ever is directly correlated to your credit score. If you've got, I was just pricing somebody out last night, even with as little as 5-10% down, if your credit is excellent, mortgage insurance is really, really small right now. It's really, really small. Now, if you have less than perfect credit, it does get more punitive. That's definitely something to consider. Mortgage insurance moves in 5% increments. After 5% down, then 10% down, then 15% down, it's a lower rate, just like insurance, just less risk. It gets cheaper. So the more equity you have, the cheaper the mortgage insurance.
Yeah, I would think that mortgage insurance would be lower just because there's so few defaults, notices of delinquent. I mean, people that are borrowing these days are strong borrowers, so they feel comfortable that they don't need the insurance.
Yeah, and the data continues to support people with good credit. Typically, their default risk is so low now, especially since 2008, since the meltdown.
You said, Ben, last year the program they had that they ran out of funds in November. I read somewhere with this new program that there's limited funds as well. What's your thought process around how long this will be around?
Yeah, I've read the same thing. I've even read crazy numbers like people saying there's only going to be 3,000 people that are going to get this program. I don't know the details on it. That Equity Builder, like we said, it was out all year and it ran until the end of November. I think it was about the 20th of November where it ran out last year. So it almost made it all the way through the year, and that was a very busy first half of the year in the markets. Definitely slowed down, but I don't know
And what was the amount? Because this is like 300 million set aside. Did I hear that right?
That's what I read, 300 million.
300. And then how about the Equity Builder last year? Was that a similar amount? Do you remember?
I don't know. I don't know that
yeah,
stat.
Us too. Yeah. Okay. That's cool.
Somebody I heard talking about this yesterday, and they predicted 90 days. That's how long the money lasts. So if you're someone who's thinking about buying a house and using this program, I would think you'd want to do it sooner rather than later.
Yeah, I would agree. And I think we all remember, what was it, 2012 or 11 when both federal and state were giving the incentives for first-time homebuyers. At first they did the $10,000 from the federal, and then they did a $10,000 from the state, and those went like, that was like a hot commodity. That should have been on eBay.
Well, okay, 300 million. If they borrow the max of 100,000, that's 3,000 people.
Yeah.
That'll get in the state of California.
There you go.
That'll last about 6 minutes, right? Okay.
Wow. Ben, you mentioned something about FICO scores. Is there a FICO score threshold for this program?
I need to verify. They're generally 620, but some of their programs are as high as 680, and
Okay.
I need to verify for this one. It's still very new to me. I do have a sheet here I brought, but I'm not even fluent on everything yet.
This just came out Monday, didn't it? I mean,
Yes,
just
it's-
like
yeah,
at
it's
the
brand
wire
new.
Monday, like you get the details figured out.
It's brand new, but that's a great question. There are some details like that, and just like everything on Cal HFA, the credit score will determine some of the requirements of the loan, such as what we call your debt to income ratio, how high you can borrow based on your income.
Got it. You know, one of the things I'm hearing loud and clear for anybody that's listening, if you're thinking about buying a home and you want to get involved in these programs, reach out to your lender, reach out to Ben, reach out to somebody in his group. That's where all this intel is really going to come from. This is like a taste of what is available, but you really got to consult with a mortgage professional to make sure that all your ducks are in a row before you even start looking at houses. I mean, heck, make sure you know what you can afford. And so when you're ready to make that offer, you've got a pre-qualification, you've got everything teed up. The last thing you want to do is go find the perfect property and miss out on it because you didn't do your footwork in the beginning. To have a good mortgage partner get you teed up so that when you do submit an offer, it looks good, it's strong. The seller's looking at you like, okay, this guy's done his homework, this gal's done their homework, they know what's going on. You're in a much stronger position. Wouldn't you agree?
I do. I agree. And it's funny, I'm looking right now at the guideline. It's actually a 680 credit score for this program, which is pretty high threshold. But that's all the more reason. The sooner you contact the lender, sooner you get ready and run a credit report, know what you're dealing with, then we can make improvements to see how we can fix your score if we need to.
So I'm going to add one thing too. So like when people go, oh, I wish I could have got the 3% or the 2.75%. You never know when that's going to happen.
Right.
And like now you've got this kind of cool program that's available for 3,000 people out of 33 million in California. So it's a small slice. So it means you can never get to a lender early enough, I think. That's the biggest mistake I see. People want, I'm going to get all my stuff in a row. Well, it's like building a house. It's like they'll tell you what you need to do first. A good lender like yourself, Ben, will tell people what they need to do and what options are available. It's just amazing. And we are a group of people that are very involved, and we don't have 1/100th of the knowledge up to the date that Ben does because it's all he does every day. So, Jay, I support you 100% in your point, and get to the lender as early as you can, and it changes all the time.
Yeah, I think to that point, Hal, I mean, one of the most important things people need to realize is that our job is to help you financially. We have a fiduciary responsibility to do what's in their best interest and to get them to the finish line. and we enjoy it. That's the most rewarding part of our job.
Right. Oh, it's not just get them in a loan they can't afford. That was 15 years ago. Okay, never mind.
Well, Jay, you're going to be happy to know I'm going to make a meeting with Ben here and go talk to him about it.
Good job.
I know the answer to this, but it has to be your primary residence, right? I couldn't
It does on this program. Yep.
live somewhere else. Hey, it was worth a shot, Hal. Besting.
You don't know until you ask.
You don't know until you ask. Gentlemen, thank you very much. This is amazing information. Sorry we were quizzing you this whole time, but it was awesome. Does anybody have any last questions?
I think Ben should let our listeners know how to find him.
There you go.
And it's
Ben,
not under a rock. Right?
Give us all your info.
Thank you. You can go. My website is my name. It's blerner, LERNER.com, or my cell phone is 805-441-9486. Anytime.
And Ben's going to be with us next week, too?
Ben's going to be with us again. We're going to force him, bring him back. So, as always, you can contact anybody, including Mr. Sweasey, hal@teamsweasey.com or hsweasey@gmail.com, or on our website, halsweasey.com. Thank you, everybody. We appreciate every single one of you. We'll see you next week.
Thank you, James.
See you guys.
Thank you for listening to the Hal Sweasey podcast. Be sure to subscribe and rate this podcast. It comes out every Monday, so check for it in your feed for the latest information on the San Luis Obispo County market. The Slow County Real Estate with Hal Sweasey podcast is available wherever you get your podcast and on halsweasey.com, where you can find current listings and other real estate tips. halsweasey.com, that's HALSWEASEY.com. I am James Bueno, Director of Marketing for the Hal Sweasey Group. If you're looking for anything real estate, give us a call, 805-781-3750.
Hal Sweasey is a licensed California real estate broker. DRE number 01111-911. The Slow County Real Estate with Hal Sweasey podcast is a production of AGM Podcasts. Subscribe wherever you get your podcasts.